I am now investing in contemporary art. And why? Because the dozens of billionaires and multimillionaires that I've had on this show, they do it too. I'm just following the leader. Since the mid-90s, contemporary art prices and appreciation have actually outpaced the total return of the S&P 500 by 164%. I want a piece of that action. So the way I do it is through a platform called Masterworks. They allow me to buy fractional ownership in those classic names, the multi-million dollar paintings by artists like Monet, Picasso, Andy Warhol, etc. If that painting is sold after I buy my ownership as a part owner, I get paid out on that sale. Or if I just want to liquidate my position prior to, I can do so on the Masterworks secondary market. Personally, I don't intend on that. I dollar cost average in. I intend to park cash there for the long term. If you're interested, check out masterworks.io and follow me down this path.
Hi, I'm Montana Yorke, and I'm your host here at Cambridge House. I'm joined today by the one and only Darius Dale of the 42 Macro. Darius, thank you for being here.
Montana, it's a pleasure. How you doing?
I'm doing very well, thank you. How are you?
I'm so good. Obviously, a lot going on in the world, so I'm excited to connect with your listeners.
Absolutely, and we're happy to have you here. Let's dive in right away. Geopolitics. Which sectors are heading where based off of this, in your opinion?
Yeah, so I'll start by saying geopolitics is a very loaded word, particularly with relates to investing, finance, kind of trying to understand and model the economy in general. The general rule of thumb, certainly on institutional finance, is to not try to trade geopolitics. What most investors do, particularly on the institutional side, is they try to sort of, find alternative ways to hedge geopolitical risk. Obviously, the most obvious would be, buying instruments like the VIX or buying puts on the S&P, puts on certain stocks, and ultimately sort of being long kind of commodity type exposures that tend to have supply shortages in and around geopolitical consternation. So that's obviously been oil, ags, grain, et cetera. You're a fool, and I mean that very respectfully to anyone listening, if you think you can sort of game the geopolitical kind of chess game, if you will, between Putin, President Xi over in China, President Biden over in the U.S., and obviously the kind of, I don't know what to call it, but the smorgasbord of European policymakers is about 100 of them, it seems like. So it's a lot going on from that perspective. We don't know the full extent of Russia's aggression in Ukraine. We don't know if the war is going to spill over into a neighboring NATO territory. And ultimately, we don't know the full extent of the West's sanctions with respect to Russia and ultimately potentially with respect to China for either its support of Russia and Putin in this incursion or potential aggression towards Taiwan. So that's my long-winded way of saying there's a lot of uncertainty out there. The markets had been in a state where they were pricing in a lot of that uncertainty into derivative products, into things that would pay off if things got worse. That's come off of quite a bit, so there's actually quite a decent opportunity now to put some of those hedges back on.
Great. And then all that being said, what are your macro forecasts currently?
Yeah, so I would say at 42 Macro, I'd say that we came into the year with sort of one variant perception. Like our biggest variant perception would have been we believe that growth is slowing to a below trend state this year. That's extremely counter to consensus. Whether you look at Bloomberg consensus, that's the summary of all the Wall Street economists and their viewpoint on growth. And both Bloomberg consensus and the Fed continue to be continue to have extremely elevated and robust growth forecasts. So if you look at Bloomberg consensus, they're up at 3.5% for 2022. That's about 150 basis points north of where potential GDP is. You have the Fed, they're up at 2.8%. That's around 80 basis points north of where potential GDP is thereabouts. And so both of these institutions are sort of, kind of corroborating each other to the extent to saying, hey, look, the Fed has the ability to pull the punch bowl away in a pretty material manner, whether you look at rate hikes or whether you look at quantitative tightening. It's our view that the Fed is hiking into a slowdown whereby the growth of the economy is likely to trend to a below trend state by the end of the year and potentially into a recession in the first half of next year. And so ultimately, on the growth front, again, this is our core call is that growth will persistently disappoint consensus expectations throughout this period and eventually cause enough consternation in asset markets to cause the Fed to back off of its tightening drive.
Great. And just touching on the Fed, what are your inflation forecasts?
Yeah, so inflation's likely to remain persistently elevated. I mean, we're in the camp, we're in the disinflation camp from these levels. It doesn't take much of rocket. You certainly don't need to have a degree in rocket science to understand that inflation's going to come down from these levels. I mean, we're at a 40-year high in the headline CPI, just off an all-time high on something like median CPI or sticky CPI. Or sorry, median CPI, sticky CPI, we're somewhere around a 30-year high. So inflation is going to come off. The problem with inflation coming off is that we're having this secondary sort of impulse associated with the commodity price shortages that are coming out of the Russia-Ukraine war. We're also continuing to see upside pressure on wages. We're at a 20-year high for something like the employment cost index. You're seeing the NFIB survey data pointing to tight labor market conditions for small businesses. So that there's a lot of sort of secondary add-on effects, second order effects kind of pushing through the system with respect to inflation. So all that means in econometric terms is that inflation is likely to decelerate, but it's going to remain stickier for longer. And so it's likely to be persistently elevated. So it's the opposite of what I said for growth, right? Growth is likely to be persistently disappointing throughout the year, whereas inflation, particularly starting in the second quarter, and then inflation is likely to be persistently sort of surprising to the upside, even though it's heading lower. And so that both of those kind of dynamics, or at least with respect to inflation, will keep the Fed actively engaged in pulling back liquidity over the medium term. And ultimately, eventually, the growth outlook will become such, deteriorate fast enough or deteriorate to a state or a condition, rather, that will cause the Fed to ultimately start to favor growth and supporting asset markets as opposed to combating inflation. We believe that's kind of a Q4 or Q1 event if you look into next year.
Great. Thank you so much. And just to change directions a little bit here, I would like to talk about the 42 macro a little bit, because I know you do cover these things in your content. So I'd love for you to kind of walk my viewers or listeners through the 42 macro, the inspiration behind it, and what kind of content you put out.
Yeah. So, that's a loaded question, but a good question.
I know.
Yeah. Opportunity to pitch ourselves. I mean, so what we do, kind of our core vision, our core process, if you will, as at 42 Macro, is to sort of democratize institutional grade macro risk management content. There's a big difference between managing risk and managing macro risk, and understanding where you are in these sort of key cycles between growth, inflation, policy, positioning, et cetera. And ultimately, and sort of risk managing that from a thoughtful portfolio construction perspective relative to what tends to happen in macro, particularly when you look at finance Twitter, which is a lot more narrative based, sort of kind of not very specific with respect to positions, not very specific with respect to duration on views, et cetera, et cetera. Obviously the institutional game is very much, kind of aligned with the calendar, aligned with, the sort of sequence of taking down of markets pricing in risks, the kind of, the hierarchy of the types of risk markets tend to price in. And so what we try to do is distill all of that information. I've been doing this for a really long time now. Try to sort of use our models, use our framework. We have a proprietary framework called our GRID framework, where, GRID just stands for Goldilocks, reflation, inflation, deflation. Those are the four states that an economy or asset markets can be in. We're using our ability to sort of measure, map, and ultimately accurately forecast what states the economy is going to be in. And that informs our portfolio construction decision making, our views on asset markets and on policy. And so, right now it's been a fun time to sort of be doing what I'm doing, because typically this is the kind of year, or the kind of this is the kind of market where a lot of retail investors tend to do very poorly. There's a lot of headline risk coming from one direction or another. There's a lot of sort of volatility that, can kind of get you caught off sides in both directions. And ultimately what we're trying to do is, and I think we're doing a pretty good job of reminding investors, hey, these are the big things that actually matter. These are the kinds of things that are going to really determine your performance and ultimately the performance of asset markets over the medium to long term. And so all those things, for the most part, are moving in the wrong direction as it relates to what retail prefers to do, which is buy the dip, right? They've done a great job of buying the dip over the past couple of years. Most data will show that. But ultimately, we're no longer in a buy the dip market. It's our belief that we are in a bear market, and that bear market's not going to end until the Fed pivots dovishly. And it's our view that the Fed is unlikely to pivot dovishly until market conditions get bad enough at some point this year or early next year, for them to support them making that kind of a pivot. So so in terms of 42 Macro, what we do is just helping investors kind of stay abreast of those dynamics, and ultimately through the lens of kind of actionable portfolio construction guidance, which is why people engage with us.
Great. Thank you so much. And then if people wanted to find that guidance, Darius, where would they find that?
Absolutely. So certainly come check us out at 42macro.com. I'm pretty active on Twitter at 42macro ddale, DDALE. So definitely come check us out. At the bare minimum, I know we have products for everyone, but at the bare minimum, I do believe we put out a lot of good free content that is, at the bare minimum, just helping investors stay focused on the right things, because there's so much noise out there these days. It's a very crowded space, particularly anything that has anything to do with macro. But I'd like to think that we position ourselves separate and apart from that kind of cabal of information.
Great. Thank you so much, Darius.
Montana, it's a pleasure. Thank you. I look forward to next time.
Absolutely. Me too.
Cheers.